So here's an example of how you could hedge with a futures contract. A utility company will need to buy 100,000 barrels of oil in 10 days' time. And they're worried about fuel costs. So if I need to buy something in the future, I'm usually worried about the price of it increasing in the future and therefore it being more expensive. Suppose you go dot, dot, dot. Okay, so and if I'm worried about the price of it increasing in the future, that means I'm going to buy it now to lock in the price. So that would be considered a long position. A buy is a long position. So I buy 100 oil futures contracts, each on 1,000 barrels of oil at the current market price of $60 per barrel. And then suppose the future price changes are shown as daily as follows. What is the mark-to-market profit or loss in each day? What is your overall profit or loss? What is the largest loss over a given period of time? So in this case, we would go long 100 contracts on 1,000 barrels of oil per contract. And the current price, or the price when we go long, the price that we start with, is 60. So now we're going to look over here at our various prices at the end of each day. Now remember, with futures contracts, they're standardized, so they're marked to market each day to ensure liquidity and protect the exchange. So in this first day, what happens? Well, we started off with a price, or we closed the day with a price of $59.50, minus we started off the day with a price of $60. So we see that the price actually went down. It moved opposite of the way we expected. So that's our daily price change times how many contracts did we buy? 100 contracts on 1,000 barrels of oil each, and that price is per barrel. So we need to include that in there. So on our first day, we had a loss of $50,000. Now, I can carry this information down, but this 100,000 and this 100,000 and, that 100,000 remains the same. So all I need to do now is just drag this down to have it do the calculations for the other days as well. So on the next day, the price went down as well. It closed at $57.50 per barrel after having opened at $59.50 per barrel. So again, the market moved against me on that 100,000. So I'm now out $200,000. The next day, the price starts to move up. So each day, the price variation is relative to what it did the previous day. And that's what we mean by marking to market on a daily basis. Your ending position then is the sum of all of these gains and losses. So I can go over here to the auto sum, and that's a positive $250,000. Now I can confirm that over here by looking at my cumulative daily gains and losses. So in this case, you're just going to be adding on any previous gains or losses from the previous day. So in the first case, it's just 50,000. Then it's 50,000 plus whatever the previous day plus whatever the current day's situation is. And you can drag that calculation down to have it fulfill all of those, and you will see by the last day, these two cells show you the same thing, $250,000. So the total profit or loss over that 10-day period is a $250,000 profit. So you guessed right. Look, the price did increase. You were worried about it increasing. You locked in at 60 and it went all the way to 62.50. The largest gain or loss on any of those days, so the largest cumulative loss you will experience over the 10-day period was our largest loss here was $200,000, which we experienced on day 2. This loss would be a problem if you had to liquidate on that individual day, but you held on to it longer, and the price did in fact go up. So you are fine. You do not need to. So we could just here. You did not need to liquidate that position. You held on to it for a full 10 days, so you were fine.